All right, thank you, everyone. We're just going to give people a few more minutes to join, and we'll get started shortly. Thanks, everyone, for joining. We're just going to give people a few more minutes to join, and we'll get started shortly. All right, we're going to get started. Thank you all for joining our first installment of our spring student loan webinar series hosted by the DC Office of the Attorney General, or OAG, and the DC Department of Insurance, Securities, and Banking, or DISB. Thank you all for being here. I hope we can provide some useful information for those of you who might be struggling with student loan repayment or default. My name is Lindsay Marks, and I'm a consumer protection attorney in the DC Office of the Attorney General. Our office investigates businesses that engage in deceptive or unfair business practices towards district residents, including student loan servicers. And we also enforce the Student Loan Borrower Bill of Rights. And we frequently work with DISB and are excited to partner today with DISB's Student Loan Ombudsman. And you want to introduce yourself, Jesse?
Yeah, thanks so much, Lindsay. Hi, everyone. My name's Jessie Myers. I'm the Student Loan Ombudsman for DC. So I sit in DISB, the Department of Insurance, Securities, and Banking, which is the district's financial regulator. Essentially, as a student loan ombudsman, our job is to support student loan borrowers. And so if you have questions about your loans, we can help you navigate repayment. We routinely hear from borrowers, I don't even know where to get started. That's totally okay. Our job is for you to be able to have a resource to talk about your loans with, understand your rights, and understand your options. In addition, we also help attempt resolution with student loan servicers. So if you also have a complaint or a concern about your student loans, we can work with you and with your servicer to get a response to that issue and hopefully resolution. So we routinely escalate complaints to student loan servicers as well as the Department of Education. Super excited to be partnering with OAG. We work together frequently on student loan issues and emerging issues that we see in this space. So all that's to say is if you have any questions at all or concerns, and maybe there's going to be a lot of information here. So if you are trying to understand, okay, well, what does this mean for my circumstance? I have X, Y, and Z to navigate with my student loans. We want to be there to help. So with that, Lindsay, are we good to get started on going over repayment and default?
Yeah, maybe we should just say that we will have time for questions at the end. And there should be a Q&A feature in the app that you can go ahead and use. If that feature isn't working for you, you can go ahead and email oag.studentloanhelp@dc.gov, and we'll include that in the Q&A. We do ask that you try and keep the questions today generalized. And if you have specific questions about your specific loans, you can reach out to Jesse at another time.
Yay. Okay, amazing. So we'll go ahead and get started. Okay, so today we're talking about sort of an overview of repayment and a little bit about delinquency and default. I know that this is an area we've heard a lot of conversations with borrowers that there's, a lot of news coverage about the default. You might have heard the phrase default cliff. You might have heard about collections starting, something called wage garnishment. We just want to acknowledge that this is a stressful time. It's really overwhelming seeing these headlines, particularly as a borrower or if you're struggling with repayment. And so again, just want to emphasize that we're here to help and try and cut through this, and that we're always happy to engage in loan counseling to get a tailored solution and understand your options for your circumstances. Let's start with some high-level definitions. Sometimes people can use delinquency and default interchangeably, but they're actually two distinct things. So what delinquency is essentially when your loans are like late after a missed payment. So after a day after your due date, if you haven't made a payment, the loan becomes delinquent. So this can result in potential late fees after 30 days. It depends on the type of loan you have. So if you're like, okay, well, I know I'm late on my loans and I don't see any late fees, that doesn't mean something is wrong. It's dependent on your loan type. It also means there can be negative credit reporting after 90 days or 3 months. What is negative credit reporting? It's a good question. So this is data in your credit report that can negatively impact your credit overall, like your credit score. So late payments or missed payments are negative examples of negative credit marks. The reason that this is important is because this can impact your ability to access other forms of credit. So if you're late on your student loans and you're interested in, say, opening a small business, it can be more difficult for you to get funding for that small business. Securing housing, whether this is getting a loan to purchase a house or even applying to apartments. Oftentimes, landlords will pull your credit score to check, and it might be harder to get an apartment. In some cases, employment could even be impacted by your credit report and credit score. So, you just want to emphasize this: of these are all downstream impacts of what delinquency can, how it can impact your life day to day. Default is what happens after 9 months of non-payment. So it's 270 consecutive days. After 270 days of non-payment or 9 months, your federal student loans enter default. So that's a little bit on definitions. Again, if you have questions about some of the nuances here, feel free to put them in the Q&A. And also just want to emphasize the oag.studentloanhelp@dc.gov. You can submit questions there. Okay, another question we get a lot, understandably, is how did we get to this point in the market? Like a lot of folks are like, hey, I just know I wasn't paying for many years, then payments kind of started again, and then I saw headlines related to collections. What's going on? So let's take a step back. This is kind of an overall timeline of the market. So in March 2020, a payment pause was instituted as a result of the COVID pandemic. Payments started again in October 2023. So you might have started receiving a lot of communications from your servicer around this time. But really notably, for a year, the Biden administration instituted something called the on-ramp period from October 2023 to October 2024. Why are we talking about this in the context of delinquency and default? This is important because what this meant is that there was no negative credit reporting happening at this time. So in other words, late payments were not being reported to credit bureaus. So the reason we're seeing a lot of conversations now at the start of 2025 and continuing now is because that on-ramp expired on October 2024. And then because of the 90-day timeline that we talked about with negative credit reporting with student loans, the first time that you might have started seeing delinquencies on your credit report or notifications of a reduced credit score, the first time you would have started getting that would have been in Q1 2025. And then in spring 2025, borrowers started experiencing default and seeing their loans enter default. And we'll get into a little bit more about what the impacts of default are. And so if you're a borrower in default, you can get a sense of, okay, what this means for you. And we'll talk about options as well. I hope this is helpful, though, in terms of getting a sense of how we got to this moment. Hopefully this breaks it down a little bit more, but again, just want to acknowledge this has been a confusing time with a lot of policy changes. And so if it's feeling overwhelming, it's because it is, and there's a lot of changes in this space. So it isn't something that you've missed. I want to make that clear to people. Okay, so we're going to start talking about repayment options first. Get a sense of some repayment strategies, overall definition, some ways that you can check your own data with your loans, and then we'll get a little bit more into delinquency and default. So let's start with some definitions. Today, we're talking about federal student loans. This is really important. So most people have federal student loans. So if you're like, oh my gosh, I don't know if I have federal student loans or private loans, it's likely you have federal student loans. Federal student loans are made by the U.S. Department of Education. You can check if you have federal loans a few different ways, but generally, if you are able to create an account with studentaid.gov and you use your date of birth and I think your social security number, all of your federal loans will be, that's sort of like a central depository. If you have questions about that, definitely put it in the Q&A. I know it can be a bit confusing because there's a difference between studentaid.gov and then the website you go to with your servicer where you might be making payments. But overall, most people have federal student loans. Your student loan servicer, so this is a phrase we're going to be using a lot today. So who is a servicer? Your servicer is the company that sends you your bill each month. So your servicer might be Mohila, it might be Advantage, Ed Financial. These are all uh, entities, I should say. I was about to say people, but entities that you're receiving communications from. Um, they handle really the day-to-day of your student loan. They are collecting payments. If you have questions, like if you're calling the number on your billing statement, that's typically to your servicer, and they handle other administrative tasks related to your loans. Two other definitions that we'll be talking about today. So your principal balance. This is the original amount you borrowed plus any capitalized interest. And capitalized interest is different from accrued interest. Principal balance is the foundation of your daily interest calculations. Accrued interest is interest that builds up over time. So in student loans, interest accrues every day. If that accrued interest isn't paid, the interest may be added to the principal balance, and that is just another way of saying that it's capitalized. And then that interest will have interest charged on that. So it's a little confusing, but all that's to say is like principal balance is the original amount you borrowed plus any capitalized interest. And then you also have a bucket of accrued interest where you'll hear a phrase capitalizing events. That accrued interest bucket gets added to your principal balance. Okay, that was a lot of financial terminology. You might be sitting here and you're just like, okay, Jesse, how do I how do I look at my loan information? I just want to know where I can find my information. If you log into studentaid.gov and click on My Loans at the top, you should see your total balance listed there, the amount you've paid, the amount remaining. We just talked about that principal balance versus the outstanding interest. So that will also show at the top. So screenshot this page. As you can see, studentaid.gov is a really important depository for gaining a lot of information about your loans. So if you're like, I want to meet with Lindsay and Jesse to talk about my loans, what we do is we use studentaid.gov to be able to dive into your particular loan situation. So it's important that figure out how to log in and get access to that. Before we dive into repayment plans, I want to talk about repayment strategies. A lot of our loan counseling starts from this perspective. There's three major strategies for tackling student loans. This comes from EdCap. Lindsay, I don't know if you'd be able to send in the chat or through Q&A like a link to EdCap. They're a really great organization based out of New York. They have a lot of great articles about student loans, including information related to repayment and forgiveness. But they have a whole article on repayment strategies. What I really want to emphasize in talking about this is that there's no one size fits all for how you tackle your student loans. We're going to be talking about a lot of different decisions that you have to make with your student loans. And I want folks to know that it's highly personalized and you know what's best for you and your student loans. We are going to help equip you with the information to make the best decisions possible, but there are many ways to tackle the debt that you have. So there are different ways to think about it. For example, strategy one, pay off debt quickly. So the goal here is to reduce your balance as quickly as possible. Perhaps this means making more than the monthly payment that you have each month, making large lump sum payments. If you're able to approach debt this way and you feel like this works for you, then feel free to explore this. So this would be some of the fixed repayment plans that we're talking about in a little bit. Another strategy is paying the minimum amount and pursuing different forgiveness programs. So this might include public service loan forgiveness or PSLF. If there's anyone here that works for DC government, works at a nonprofit, this might be a really good option for you. income-driven repayment forgiveness or IDR forgiveness. Income-driven repayment plans are plans that tie your monthly payment amount to your income, your family size, and tax filing status. We'll get into the details here in a little bit, but essentially after 20, 25, and with a new plan that's being introduced, 30 years of repayment, IDR forgiveness could be an option for you. There's also something called teacher loan forgiveness. I'll put a pin in this. If you're a teacher and want to talk about this, definitely let us know. Generally, PSLF is going to be the more attractive alternative, but it's highly situation dependent. So point is though, is that with this strategy, what you're doing is you're trying to minimize your payment each month, pay as little as possible, and just keep making progress towards forgiveness. In this circumstance, you're going to want to explore income-driven repayment plans. That's distinct from the fixed repayment plans that we talk about in strategy 1. Because again, these income-driven repayment plans or IDR plans are tying the amount you're paying to your income. With fixed repayment plans, that's tying the amount you're paying to your overall debt size. And so income-driven plans might be a more attractive alternative and is likely to result in a lower payment for you. I also want to note too, if there's any borrowers pursuing PSLF on this call, then generally IDR plans are what you're going to want to pursue in order to make qualifying payments. And then strategy 3, this is maintaining a minimum payment throughout the life of your student loans. So this is making the minimum required payments under the cheapest plan. Typically, what this means is exploring IDR plans in conjunction with forbearance and deferment. I saw someone in the chat asked a really good question. What is forbearance? So both forbearance and deferment you can think of as essentially pauses to your payments. The nuances here differ. So like, for example, generally forbearances will accrue interest, whereas deferment will not. It looks different. There's different types of forbearances. So for example, you might be a borrower on a SAVE forbearance if you enrolled in the SAVE plan. And, for up until August 2025, no interest was accruing in that forbearance. But then after that point and up until now, interest is accruing on the SAVE forbearance. So the details are sort of dependent. There are many different types of forbearances. The eligibility for PSLF can differ depending on the forbearance you're in. It can get really detail oriented, I would say, with the different types of forbearances and deferments. But overall, if you're a borrower and you're like, hey, what are these options? You can think of it as a short-term pause to your payments. But many of these are also time limited as well. So I want to stress that. So it's not really a long-term solution to repayment, whereas income-driven repayment plans are. Okay, covered a lot on this slide. I hope this framing is helpful for folks. But again, just want to emphasize it's so highly dependent on your given circumstance and your current financial picture. No strategy is better than the other. And we're happy to talk through what might make more sense for you and what your options are for each of these strategies.
Jesse,
Okay.
before we move on, do you want to quickly talk about the difference between like forbearance that a borrower might request and one that sort of happens automatically?
Yeah, that's a really good question. So for example, the SAVE forbearance is a good example of an automatic forbearance based on like litigation. Another good example of this, for example, is okay, you might be listening to this, you're hearing a lot about income-driven repayment plans, you do some research and decide that is a good alternative for you. When you submit an income-driven repayment application, you should be placed in forbearance automatically. And so what that means is you shouldn't receive any billing statements while that's being processed. In fact, when you submit it, you should be put in something called a processing forbearance, where you should be getting public service loan forgiveness credit. So you just want to emphasize that because we've seen some issues there for borrowers. So that's one example where it's automatic. One example where you might call and request one, and we'll talk about this, for example, is if you're delinquent, you might call and request something called a retroactive forbearance. So It's always worth calling your servicer and talking with them about what your options are. Generally, income-driven repayment is where you want to start. But if for whatever reason that isn't a good option for you, say for example, even with the cheapest income-driven repayment plan, you're like, wow, I am in a tough spot right now. You might want to opt into a forbearance. Or explore different types of deferment. So, for example, there's an unemployment deferment that might be something you want to explore. If that applies to you and if you lost your job, definitely let's have a conversation about what your options are. Because also what you could do is with income driven repayment is report that your income is zero. Because, you know, when you lost your job, your income went to zero. You can recertify if you're already in an IDR plan, or if you're signing up for the first time, you can report an income of zero. And it might be the case that you have a $0 monthly payment, depending on the plan. Is it, Lindsay, did that make sense? And do you have anything to add?
No, I think that covers it. Yeah. Thanks, Jess.
Okay, cool. Point is, I know that was a lot. There are instances where you might be moved into a forbearance. You should be able to call your servicer and ask why that's the case. If the answer still isn't clear, definitely reach out to us and we can help you figure out why you were placed into forbearance. Okay, there are changes coming up. Your options are going to look different for repayment generally after July 2028. And also, if you're thinking about borrowing more, so like if you're going back to school, if you're currently in school, you're borrowing after July 2026. This is a really high level overview of what those changes are. Feel free to take a screenshot of this. Okay, let's break down the slide, what's going on here. So on the left, we have what the current plans are that are in place. We're going to be covering the ones on the left today. The ones on the right are future plans. The payment, or sorry, the text in blue are, okay, we talked a lot about income-driven repayment. The ones in blue are IDR plans. So that means that your payments are going to be tied to your income, your family size, and your tax filing status. The fonts in orange, and that includes the standard plan, graduated repayment, extended repayment, and then on the right, tiered standard. These are payments based on your overall debt balance and a certain period of time. So again, we talked about the different repayment strategies and what options you might want to explore depending on what makes the most sense for you. We talked about what fixed payment is versus income-driven repayment. So that's what the orange versus blue are. A few notes here, and we are going to have future webinars on this topic. We're not going to be diving into all the differences here, but the main thing to know is that currently the ones on the left is what's available. The two plans on the bottom, ICR, income contingent repayment, and pay, are going to be sunsetting after July 1, 2028. These options also will look different depending on if you're borrowing or consolidating after July 2026. A quick caveat here, if you are a Parent Plus borrower, meaning that you have debt related to a dependent, please reach out to us. There's a really important deadline coming up related to Parent Plus borrowers and preserving your eligibility related to income-driven repayment and by extension, public service loan forgiveness. So if you're like, oh, I'm a Parent Plus borrower, please do reach out to us to talk through certain steps that you need to take around April 1, so in a few weeks. Please join our webinars to learn more about these options. There's a lot of different threads of what might make sense for you and sort of what your future plans are. And we can walk you through how future changes might impact your certain circumstances. And join us on March 25th if you're a Parent Plus borrower. Okay, I teed all that up to just hit home the point that things are changing in the future. But right now, as of us talking today on March 19th, 2026, here are options available. Okay, we talked about the fixed payment plan bucket. Again, these are payments that are based on your balance and a fixed time period. Generally, these plans are ineligible for PSLF. There's a minor caveat there related to the 10-year standard plan, but generally you're going to want to enroll in income-driven repayment if you're pursuing PSLF. I won't get into the weeds here. Standard repayment, essentially, it's a fixed amount over 10 years. Graduated repayment, your payments start lower, and then about every 2 years will increase. Extended repayment payments are either fixed, stay steady, or graduate over time, and it will ensure that loans are paid off within 25 years. The main thing to know is that all of this is based on, again, your debt size and a fixed amount of time. Current income-driven repayment plans. Again, these are based on your income, your family size, and tax filing status. Current income-driven repayment plans are income contingent repayment, or ICR, income-based repayment, or IBR, and pay-as-you-earn, or PAY. Essentially, what all of these programs offer is generally they're going to tie the amount you're paying to about 10%, 15%, 20% of your income and offer forgiveness within 20 or 25 years. If you're in the save forbearance, you will have to pick a new IDR plan in the future. We're waiting on guidance from Ed. We're not quite sure how this transition will occur or what it will look like yet. But we should expect that you'll probably have to change plans sometime in the spring would be our best guess. It might be later this year. If you're a borrower who's in the save forbearance and you're like, I don't know what the best option is for me, definitely reach out to us. It is totally within your right to stay in the save forbearance. The thing to know is that interest accrues and you're not making progress towards PSLF. But for whatever reason, if you're like, I really can't swing monthly payments, you can stay in the save forbearance. But if you're like, wow, I'm concerned about this interest accrual, or I'm concerned I'm not making progress towards PSLF, then you can apply to one of these alternative income-driven repayment plans. How do you know what's best for you? There are lots of great online resources to estimate what your payments are under these different plans. So Federal Student Aid, or the Department of Education, has a calculator where you will log into your studentaid.gov account, you will answer a few questions, and it will bring in your loan information to give you an estimate of what your monthly payments would be under certain plans. And it also calculates your eligibility for certain plans. For example, with like pay, there's an income qualification element. So, it will assess your eligibility through the calculator. We also want to emphasize EdCap's calculator. These are our partners in New York that we talked about. Sometimes it can be helpful to sort of compare what the output is across both the student aid simulator and the EdCap simulator. If you're getting a really differing amount, definitely come and talk to us. We've also heard from some borrowers reports of different calculations of what their payments are under a given IDR plan. So if you have any questions at all, point is about what these estimates are saying, we're happy to help you walk through that. Generally, the loan simulator is what we are referring people to, but you can kind of double check using the EdCap calculator. Okay, stop there. That was a lot. We're taking a deep breath. So that was an overview of our repayment plans. Point is, there are many options available. There are two buckets of options, the fixed repayment plans and the income-driven repayment plans. IDR is important if you're interested in lowering your monthly payments and pursuing forgiveness options such as public service loan forgiveness and IDR. You can simulate your payments online. The one thing I want to flag too is you can also apply to IDR online at studentaid.gov. Lindsay, I don't know if you're able to send in the chat the IDR link. I don't know if the chat's working.
The chat's off, but we can follow if people they can follow up with us for specifics on these links.
Yay.
And
okay, perfect.
This also will be recorded if you want to rewatch it or share it with somebody. We'll have it eventually posted.
Okay, great. Thanks, Lindsay. Um, when applying to IDR, there's an option to have your income pulled from your last IRS filing, which leads to faster processing of IDR applications. And it can make your life a little bit easier because you don't have to find income documentation. So highly recommend applying online using that IRS direct file tool. We've seen borrowers able to apply to income driven repayment within 5 or 10 minutes by using these tools. So if you have any questions, reach out. Okay, that's repayment overall. Oh
Um,
yeah,
bef Before we continue, I see a lot of you are putting questions in the Q&A function. Just a reminder, if you're unable to access that, you can email. But we will save time at the end to try and go over all your questions.
yay. Thank you guys for submitting questions. Um, okay, let's dive into delinquency and default. Okay, this is our second timeline of today's conversation. So earlier we covered an overview of the market. For a given borrower, this is the timeline of delinquency and default to know. So in other words, all of delinquency and default is in relation to your payment due date. So the very far left dot is whenever your payment due date is. Let's say you miss a payment and after 1 day, the loan enters a delinquent status. So it's essentially like late. After 30 days, you have the potential to incur late fees. Again, this is dependent on the type of loan. After 90 days, the late payment will be reported to the credit bureaus. And so then you could see your late payments on your student loans start to impact your credit score, for example. And then after 270 days or 9 months, your loan enters default and will be referred to the servicing entity that manages default, which is called the Default Resolution Group or DRG. So if you're a borrower in default, you would have received a notice of transfer to the Default Resolution Group or DRG, and that will be your contact in terms of some of the options that we're going to talk about in a little bit. So I know we talked about this a bit early on, but just to put a fine point on it, the consequences of delinquency or missing payments on your student loans. You have the potential to incur late fees. Again, this is based on your loan type. For direct loans, there are no late fees. For FFEL loans, you have the potential to incur late fees. There are negative credit score impacts after 90 days. This has some of the downstream effects that we talked about in the beginning, which can impact your ability to secure housing, employment, or other forms of credit. And that really want to emphasize too that these past due payments can remain on your credit report for 7 years from the initial delinquency. So these could have longer term impacts too on your credit score. So how can you check if your loan is delinquent? There's a few different ways. You can visit your servicer's website, and past due amounts will be typically notated in red with text that says past due. You can call your servicer to check on your delinquency status. You can also request a credit report from annualcreditreport.com. I forget the exact cadence, but you can get a free credit report. I want to I don't want to share wrong information, at least annually, but I think it's more frequently than that. So you can also check your credit report as well. But typically the easiest way to do this is to call your servicer and log into your servicer's website. If you're wondering who your servicer is, again, this is the entity that's typically contacting you about your student loans. You can log into studentaid.gov, and on the right side, as soon as you log in, your servicer's name will be listed. And you can also call the Federal Student Aid Information Center at 1-800-433-3243. Let's say your loans are in a delinquent status. What can you do? So if you're able to make a payment, you can enroll in an income-driven repayment plan. If you have questions about this, again, reach out to us. Oh, 5 minutes. I'm going to speed through. You can enroll online as well. And again, you should be placed in a processing forbearance when you submit that, which should be eligible for PSLF. You can call your servicer and request a retroactive forbearance. And you can also consider enrolling in a deferment or forbearance. Consequences of default. So again, this is 9 months or 270 days of non-payment. There's a lot of different impacts of default, and they're uniquely severe in the federal student loan space compared to other types of credit products. So something called acceleration occurs, which means the entire unpaid balance of your loan becomes immediately due. Your loan becomes ineligible for forgiveness, deferment, or forbearance when it's in a default status. You are not able to borrow more federal student loans or grants. And importantly, your tax refunds and federal benefits can be offset, meaning reduced. Your wages can also be garnished up to 15%. Want to note that wage garnishment and tax refund in these federal benefit seizures or offsets have been paused since January 2026. We do not know right now how long these will be paused. I wanted to keep them here so that folks are aware of the impacts of default. You might very well be in default, but not experiencing wage garnishment. And we'll talk about how to check if you're in a defaulted status. And then in addition, there are negative credit impacts, and you can be charged court costs or collection fees. Another thing I want to emphasize that isn't on the slide too, that's distinct for debt collection in this space is the government can garnish wages and seize tax refunds and federal benefits without going to court, and there's no statute of limitations on collecting federal student loan debts. So this could mean you could face collection actions or see some of these impacts on default for debts that are years old. So I just want to emphasize that because sometimes we get questions about the timeline of default. Okay, so how can you check for your loans? If you log into studentaid.gov and select dashboard, you should see a banner at the top that's listed here that says the number of loans that you have in default. You can also log into studentaid.gov, so same website, select My Loans. You'll scroll down, you'll see kind of a tiered list of all your loans listed out, and there will be a column that says loan status, and you'll see default for any loans that are in default. If you're a borrower in default, first off, we're here to help. So if you're like, I just still don't know how to tackle this, that's totally okay. Reach out to us, we can help. There are options available to you. So generally the sort of two paths of getting out of default, one is consolidating. This means you repay the defaulted loan with a new direct consolidation loan. Or you can rehabilitate your defaulted loan. This means entering into a written, that's really important, it's a written agreement with your loan holder to pay 9 reasonable monthly payments on time and in full within 10 consecutive months, so 10 months in a row. There's some nuances here, and if you have questions about who your loan holder is, generally, if you're with the Default Resolution Group or DRG, you can reach out to them regarding rehabilitating your loan. If it's not DRG that holds your loan, then reach out to us for other options and how to still plug into the rehabilitation option. There are trade-offs between these options. This is a really deeply personal decision. We're happy to walk through what sort of the pros and cons are. It's dependent on your loan history. It's dependent on your default history, your consolidation history. In addition, there are some changes in terms of the number of times, you can, I believe it's consolidate to get out of default. Point is there are limitations, there are changes. And so if you have questions about this, reach out to us. And also we want to encourage people to continue to explore forgiveness and discharge options. For example, if there's discharge related to school misconduct, for example, through a program called Borrower Defense to Repayment. So just, be sure you research that. There are also programs called Total and Permanent Disability or TPD. So this is another option that might be available as well. Okay, we're going to end on rights and protections. We just covered a lot. There are protections specifically related to federal student loan collections. So specifically for wage garnishment, for example, there are limits to the amount that the government can garnish. Again, this is currently paused, but it's unclear how long that will be for. You should also receive a notice before any wage garnishment or offsets, which, again, is for federal benefits or tax return seizures. You should receive notices and an opportunity to request a hearing. So, for example, if you are worried that you've been mistakenly put into default, definitely reach out to us. And there are avenues to be able to dispute your default referral, for example. We want to make it clear that folks have a right to timely, accurate, and complete information about your loans from your student loan servicer. Debt collectors can't contact you outside of 8 a.m. to 9 p.m. If you ask a debt collector to stop contacting you by email or text, they can't continue to contact you, and they can't call you more than 7 times within a 7-day period. So if you're concerned about anything you're seeing here, as it relates to debt collection or information about your loans, feel free to reach out to us. Okay, that's all the information we had. Sorry that was really long, but I think we can dive into Q&A now. Does that sound good, Lindsay?
Yeah, I'll go ahead and read some of these. So you already answered what it means for a loan to be in forbearance. Can you talk about the sort of length of time over the whole life of the loan that are there any limits to how long you can be in forbearance?
Yeah, that's a really good question. I see it in the Q&A. Yes, there are limits. So at the top of my head, I'm not quite sure, and I don't want to give any incorrect information. I'm not sure the exact bucket, like how much time there is, particularly because there are some changes in 2027 related to, I think it's like unemployment deferment, I want to say. So point is like these buckets depend on the type of forbearance and deferment, but generally, yes, they are time limited. What I recommend to folks is call your servicer and ask them to help explain, like, okay, sort of where am I at in terms of my particular circumstances um, of how much forbearance time I've used. But for example, like the save forbearance, that's kind of like we don't know how long that will last. So I know that's not super clear. I would say call your servicer and ask would be my best advice. But generally, yes, forbearance and deferment are time limited. And that's why we recommend exploring income driven repayment because that is a long term strategy for tackling payment overall.
Okay. We have a few questions about the public service loan forgiveness. What loans are eligible for PSLF?
That's a great question, and that's an important question. So loans are only forgiven under PSLF if they are direct loans. So that means if you have FFEL loans or Perkins, you're going to want to make sure you consolidate. So it's really important that they're direct loans. How should one start the process of applying? So if you go to studentaid.gov slash PSLF, you will see the PSLF help tool. Log in. As a borrower, really what you want to make sure you're doing is you're certifying your employment generally on a yearly basis, but you can do it as you'd like. Um, you just need the EIN and some sort of email, like an HR email through your employer. So maybe in the wrap up email for this call, we can send out if you're a DC government employee, what the EIN is and what the email is. But yeah, those are the steps. Really, in terms of applying, what you want to make sure is you want to check your loan eligibility, look at studentaid.gov to see if you have direct loans. And if you don't, talk to us. And you want to visit studentaid.gov backslash PSLF to start verifying your employment.
And if somebody doesn't know what type of loan they have, how can they find that?
That's another good question. You will log into studentaid.gov and click on the My Loans tab at the top on the gray banner, and it'll give you a list of all your loan types. We understand though that that could be very overwhelming. Many people have many types of loans, so feel free to reach out to us if you have questions about what you're seeing.
Okay, another PSLF question, and I think I understand what this question's asking. For borrowers who have moved between IDR strategy or PSLF strategy, can you sort of provide a recommendation for those folks?
Yeah, what I sort of tell people is that it can be two tracks at the same time. So you don't have to view it as like, oh, I'm definitely PSLF, but not IDR. Generally, PSLF, you're getting forgiveness over, 120 monthly payments or 10 years versus IDR, which is typically a longer period. So most commonly, we see forgiveness earlier for PSLF. But yeah, like in terms of strategy, I think generally you're in an IDR plan anyways for PSLF. So I just view it as sort of two tracks that you're on. And my biggest advice to both on the borrower side, just make sure you're documenting your payments and logging into studentaid.gov to track your progress. Obviously, the IDR counters are not available, but PSLF you can still view your progress for.
And if you wanted to know how many qualifying IDR months, how would you find that? Would you contact your servicer?
I That's a good question. Because yes, I would try, but I think we've heard from folks that I'm not sure servicers have the information. I think reach out to us if you're not sure. Generally, it's time and repayment. So, like, if you've had student loans for 20, 25 years, and you like consolidated in 2024-ish prior to June 2024, um, reach out to us. You know what? If you have loans older than 15 years old, just reach out to us. We can help you with that question.
Okay, the last question is about the upcoming changes that are happening in July. It's about whether loans will be automatically converted into those new payment plans.
Okay, that's a really good question. It sort of depends, but generally the answer here is no. So for example, here, let me actually go back to the current versus future plan slide. Um, So if you are not borrowing more or consolidating after July 2026, your options will look different versus if you are borrowing after that point. But generally, I don't believe loans are going to be converted to this tiered standard, with the exception if you're borrowing after July. Does that make sense? So it's like, it's really about your options and what will be available to you matter related to July 2026. But generally, I can't think of a circumstance in which any borrower would be converted into tiered standard. But that will be the default if you borrow, like, let's say you borrow this coming fall and you graduate in a few years, you will automatically be put into the tiered standard plan. So that's like the default rather than the current standard plan. That's the default when you graduate now. For that person, I hope that answered that question. But if you're not borrowing more than after July 2026, I'm not sure you have to be concerned about the conversion. Like you'll still have a different suite of repayment plans available to you.
So like for example, the IBR, ICR, and pay will still be available for borrowers who aren't borrowing more money. If you're
Yeah,
currently on that plan.
and I believe like standard graduated and extended to like the older versions. I believe. I maybe want to double check that. But yes, like IBR, ICR pay will be available with, and then just note that ICR and pay are phasing out July 2028. Are there any other questions?
Maybe go back to how they can contact us if they do
Oh,
have
yes.
questions.
Because that was a lot. And again, like I always emphasize to people, like, it isn't that you're missing something or like it's just not clicking or like just it's a lot of information. There's a lot here. And so I just like really want to emphasize, please reach out to us if you have questions. It can literally be like, I don't know where to start. I just need someone to help me walk through this. We're happy to do that. Um, so yeah, but reach out to us.
Yeah, thank you for attending. We have other webinars next Wednesday, the 25th, April 1st, and April 8th. Those are on different topics. One on Parent Plus loans, one on public service loan forgiveness, where we'll dive more into those topics.
Thanks so much,
Thanks,
everyone.
everyone.